So buying a house just got even more expensive. And not only the price of homes across the country have gone up a crazy 20% since 2021, and the inventory is so horrible that maybe even buying a Home Depot home sounds kind of good. Actually, damn, that doesn't look bad at all. Anyways, like really this week, it was announced that the new median home price in the United States is now $373,000. Anyways, in addition to this, mortgage rates have gone up like crazy as well, with the average 30-year fixed rate now sitting at 5.25% or more, depending on what lender you end up going to. But to put this into perspective, your popular 30-year fixed rate at the end of this just past December was just 3%. So rates have gone up about 2.5% in maybe a matter of 4 months? There we go. And to give you even more of a perspective, if you were taking out a $500,000 loan to buy a house last year, or hell, just this past December, with a 3% interest rate, your monthly payment would have been $2,108 compared to about $2,684 if your rate is 5%. So roughly a difference of almost $580 a month or $6,900 a year. So the question is, can rates really go up even higher, like maybe 6%? And the answer is, well, yeah, maybe. And here's why. You see, back in 2005, rates were between 5 to 7%, and some mortgage loans were even at 8 or 9%. Now, one of the primary reasons why there was a housing market meltdown back in 2006 was because a lot of people took out risky short-term adjustable rate loans that they couldn't afford. And when those rates, just basically adjusted, the payments went up so much, they simply couldn't afford to make them anymore. So for instance, some people will start with a rate of say 5%, and then once the fixed period ended, which was anywhere between 6 months to a year, the rate would jump to 8%. So it's not like higher interest rates haven't happened in recent memory, because guys, they really have. And we don't even have to go that far, because in 2017, rates jumped to almost 5% right after the election, and the economy was in a pretty good shape back then, so there wasn't much of a need for more Federal Reserve injection of money into the economy. And from there, rates sort of jumped between 4% to the high 4s until, well, COVID happened. But okay, so we're here and now we're in 2022, and this is basically what's been going on. So you see, the Federal Reserve started pumping more and more money into the economy to keep it stimulated during COVID, and started buying billions and billions of dollars of mortgage-backed securities and treasury bonds. And because of it, it drove rates down to nearly 0%. Now, this caused mortgage rates to hit the lowest levels in history. And in fact, many mortgage lenders at some point were offering 30-year rates well under 3% back in the summer of 2020. But as a result of pumping so much cash into the economy, and that includes all your stimmy checks, social relief, social spending, the economy is now going through the worst inflation period of the last 40 years. And I think by now we all noticed that the price of basically everything has been going up by a lot. So the problem with the housing market is that the supply wasn't really that great before even COVID happened. See, the home builders have been dealing with supply chain bottlenecks for materials and the rising cost of them. And then people found out that they could, work from home or remotely, and then families, had to expand. And now the millennials became the biggest home buying population, coupled with the super low interest rates, which meant that now they could qualify for way more house than ever. And this is what we end up getting. So now the Federal Reserve has to do something to slow this down, and this is how they plan on doing it, which is by raising interest rates by a lot. So the Federal Reserve is expected to deliver at least 2 back-to-back half-point interest rate hikes in May and June of this year alone. Now, the last time the Federal Reserve actually raised rates by that much was back in 1994. And today, the Fed funds rate, which is the baseline interest rate, stands at just about 0.25%. Now, that may not seem like a lot, and honestly, it isn't. But remember, the market and even the country, and possibly even you have gotten to this rate being nearly 0% over the last couple of years. And according to many economists, the projection for this baseline interest rate is to end up around 2.75% at the end of the year. So I pulled up a history of the baseline rate and compared it to the history of the average 30-year fixed mortgage rate since 2000, and here's what I found out. Back in 2000, the Fed funds rate stood at about 6.51%, while the average 30-year mortgage rate was about 7%. Then the Fed funds rate dropped a lot after 9/11, down to about 1%, and stayed that way through until the economy started to experience one of the best times from 2004 through the height of the housing market around the summer of 2007. Now, during this time, the average mortgage rate was then about 6.4%. So, is the Fed funds rate an indication of where mortgage rates are headed? And the answer is kind of somewhat maybe. You see, the Fed funds rate better indicates the cost of short-term loans, things like your credit cards, home equity lines of credit, CDs, personal loans, things like that. So when you see that the Fed funds rate goes up, the interest rate on your credit cards typically tends to go up. Whereas the mortgage rates are better tracked by using the 10-year treasury rate. So to summarize, what is really going to take your average 30-year fixed rate above 6%? Now, the main cause is going to be through the upcoming sell-off of mortgage-backed securities. Now, you see, although the Federal Reserve doesn't necessarily affect mortgage rates directly by increasing the Fed funds rate, they do, however, affect the mortgage bond market by buying and selling mortgage-backed securities. And to help you understand what a mortgage-backed security is, or an MBS, it's basically just an investment similar to a bond that is basically made up of a bundle of home loans that are bought from banks and that is issued from them. So to give you an example, an investment banks take hundreds or even thousands of similar mortgages and they package them into one mortgage-backed security so that they can trade on Wall Street. And the Fed has been purchasing roughly $40 billion worth of mortgage-backed securities every single month in order to keep those interest rates as low as possible and keep the bond markets very liquid. But now that the economy is really starting to heat up and the Federal Reserve has started to signal that they're going to start scaling back on these mortgages and all these purchases, they basically will drive up mortgage rates, and this is what they call quantitative tightening, or QT. And look for this to be announced actually next month in the May 4th meeting, with the sales starting to begin in June. And here's the thing, the Fed has been the biggest buyer of this pool of home loans since the start of the pandemic, and now they're gonna become the biggest seller. And as these securities get sold off so aggressively, their prices will go down, which is gonna push up their yields. And when the yields go up, interest rates go up as well. And also, recent market fluctuations have hammered all types of securities, from blue chip stocks to junk bonds to pressuring many investors' portfolios. And the price of treasuries have also fallen and yields have risen, which means that the cost of borrowing tends to climb up across the board. And so far, the yield of the 10-year treasury bond, which is the one that the mortgages are so much better tied to, has gone up to about 60% from last year. And so with several economic factors, mainly inflation, which is now at about 7.9% year over year, and the highest in 4 decades, while the unemployment rate has fallen to a 17-year low of about 4.1%, we can pretty much see where this is going, guys. Doesn't take an economist to tell you that basically rates have to go up. So are we gonna see the crazy interest rates of 1981 when there were almost 20%? No, I don't think so. But I'm not also looking at a magic ball, doesn't tell me what it is. But honestly, it doesn't seem like that would be possible. But home buyers are just pretty much not gonna get a break anytime soon. So my personal take is that rates will go up anywhere between 6 to 6.5% by the end of the summer, and kind of just thread from there. So if you guys are considering buying a house, I suggest that you keep making your offers and try to go under contract before the summertime hits. Same as if you're refinancing, because these rates are not really gonna go back down. They're not gonna go back down to the 3s or to the 4s, at least for the foreseeable future, which probably won't happen for many, many years to come. And that basically does it, guys. That is my take on what is going on. So good luck to you. And if you guys like the video, make sure that you smash that like button and subscribe to the freaking channel. I appreciate you guys. Thank you so much for watching. See you next time.